So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Good afternoon and good evening. This is Merrill Chandler, your host of Are You Effable. Welcome back. So in this episode, we're going to be talking about holiday fundability killers. So when we get back, we'll go right into it. I'm going to talk about the 5 fundability killers that happen especially on the holidays. I'll see you back in just a second. Welcome back, everybody. Okay, the holidays. I'm telling you, if you're just jumping ahead because it's the holidays while you watch this podcast or listen to it, I'm telling you, we're going to talk about 5 things that most of us don't know that the holidays kind of open up a space inside of us, or we want to take care of our families, we want to take care of our loved ones. We all of a sudden we want to fly and go visit a family member or visit our loved ones for the holidays. And sometimes we are unaware of the effects that our spontaneous decisions, our extra purchases or otherwise, do to our fundability. I mean, our long-term fundability. So that's what we're going to talk about right now. First and foremost, let's talk about number 1. The number 1 harmful activity that you can do during the holidays is when you go out shopping, and you might have already seen a podcast about this, but many of you are jumping here straight from to check out the holidays. The number 1 thing is most retail stores, mall stores, even online stores may offer you a credit card. And if you fill out that application, just filling it out, they'll give you 10, 15, 20% off. Now, normally I like to say how to ruin your credit profile and save 10% on your next purchase. But these are the details. When you go to Target, you go to Kohl's, you go to the Buckle, the Limited, whoever is asking you to fill out an application in order to get that discount, they do not know that they're doing this, but you need to know that they are literally giving you the tools to ruin your fundability. Here are the 3 ways in which it harms your profile. Number 1, when you fill out that application, they're going to do an inquiry. It's a hard inquiry, and it's going to count 3 to 15 points as a hit against your credit profile. If you're if you're in the high 700s, 800s, it may only cost you 3 points or so. But if you're in the 600s, high 600s, mid 600s, it may cost you 15 points against your score. Now, while the score is not the most important fundability metric used by FICO and the lenders, it's still going to cause a drop in your score. And if you pop through a tier, a funding tier, you're going to lose unnecessary points. So the number 1 way is it's going to give you an inquiry. Number 2, the second way that getting a new credit card is going to hurt you is it is a tier 4 junk card. It is the lowest possible value card. Any retail outlet, any merchant, any mall store card is not a tier 1 100% valued card. It's junk cards. And so if you get accepted, you're going to add a junk card to your credit profile. Now, the question is, if you're spending $60,000 at Target, guys, or at Kohl's, then let's talk. Oh, it's worth $6,000 to take that kind of hit. But if you're going to be saving 20 or 30 bucks, right? 20 or 30 bucks is not worth 50 bucks. 100 bucks is not worth the long-term damage it's going to do to your credit profile. So A, you get the inquiry. B, you get a junk card if you get approved. Now, the worst thing that is going to happen to you is that if you get approved, you're going to lower the average age of your credit profile. And what I mean by average age is, and let's just make it simple. Let's say you have one credit card and it's 100 months old, right? 100 months old, it's what 8 years or plus. That 100 months, if you get a brand new Target card, Kohl's card, Victoria's Secret card, Home Depot card, if you get that new card, you have a 0 month now. So the average, you have one credit card at 100 months, you've got a new credit card at 0 months. So your average age goes from 100 to 50. Now, the interesting thing is that you're going to drop, there are tiers of aging, right? And the tiers are 2 years, 3 years, 6 years, 11 years, 25 years. Every one of those thresholds, you get more aging points, more heft with your credit cards. The age is, after utilization, age is the next most important thing for your credit profile and the value of that account to your profile. So here's the thing, guys. You're getting inquiries, whether or not you get approved. You're going to take that hit. You're going to get a junk card if you are approved. And if you are approved, you're going to get a 0 month on your average age, and that's going to lower the overall value of your revolving account portfolio. So you have a 0 month of a junk card. That is not worth it. Now, here's the interesting thing. We've talked about in previous episodes about the 24-month look back period. Well, if you're tooling around and you haven't added new cards or otherwise, and you're aging your profile, that's what that average age means. You're aging your profile and you take a hit on that average age, that triggers red flags in FICO and lending algorithms. Now you're looking for credit, but you're looking for what are called consumer finance accounts. So you need to go see my other episodes where we talk about the value of your revolving account profile. Earlier in the episodes, guys, you need to go listen to that, because a tier 4 40% junk card is just straight up harmful, and FICO actually designates it as harmful to your profile by calling it a consumer finance account. It's not a national bank card. It's not a hefty tier 1, tier 2 high value account. Okay, so that is number one. All of that is the number one of the death dealing things you can do in the holidays, because we want to save money. But please play the long game. If we're playing the funding game, then play the long game and take the $20 or $30 hit to preserve the value of your revolving account portfolio. Now let's talk about number two. Number two is, during the holidays, there is a tendency where we may want to raise a limit so that we can buy more or do more things for the holidays. Now, in that essence, there are two problems with raising a limit, especially if you have not raised your limit until the holidays. Again, that 24-month look back period is going to spike when it comes to raising a limit that you have not raised. You've not had a regular practice of raising limits. If you've had a regular practice of raising limits, it will hurt far less. But if you haven't done anything for a year or two, and all of a sudden you say, oh, let me get a limit increase, that's going to spike, and that's going to be a warning to the AUS, right? The automatic underwriting systems. And even if they approve you, you might be in the risk category, because you've not shown a regular behavior of raising limits over time. Now, the second thing that comes with that spike of raising limits is that you might actually be pushing past thresholds of too much available credit. Now, there is for my students and clients, we discuss there's a specific amount of total available credit specific to you and your profile. It's different for everybody, because everybody has different revenues, income, and different portfolios of accounts. So all of this is based on specific to your situation. But guys, you have to remember, this is vital, because if you push that limit, especially if you do this with 1 or 2 or 3 cards, If you raise those limits, you may be pushing past the comfort zone a lender has of available credit. Remember, available credit is you can go out and just charge up all of those cards and kill your relationship, because they're going to throw you into risk department, or they may freeze your card. They may limit. They may lower your balances, and we've even had students and clients where they have closed the account because of this aggressive behavior. All right. So our second fundability killing behavior in the holidays is to raise limits, especially on multiple cards. If you go outside of that available credit spectrum for your profile, you're going to take a hit. All right. And I'm just trying to protect you. The third thing, the third fundability killing activity is not just limits. So whether you raise a limit or you don't raise a limit, it's charging your credit cards past comfort zone levels into the risk department levels of your profile. So let's say you've been carrying a 50% balance on average for 3, 6, 12, 24 months, whatever it is. If you go from 50 to 75, you're going to trigger the automatic underwriting systems are going to look at you with either suspicion or with and put you in the risk department to monitor your accounts. Now, if you've been at the 10 or 20% or 0% and you go into the 50%, those are huge alarm bells for automatic underwriters, underwriting systems. So you've got to be deliberate in the type of traffic. Now, we've talked in previous episodes about what is the max traffic. So let's define our terms again. If you haven't been in any of if you haven't been binging these episodes, let's make sure that you know what we're talking about. Number one, traffic is the amount you charge on your account, presumably to pay it to zero on the due date. Traffic is how much you charge. Your balance and utilization are used simultaneously. Utilization is the amount of your limit you've used. Your balance or your utilization is the amount that is reported to the bureaus when your account is reported. The reason, and you got to watch previous episodes, guys, if you don't know this, because if you have charged it up, let's say you charge up 30%, you've put traffic, you've charged 30% of your limit, but you pay it down to zero, you think you're doing peachy. But if while you're in your billing cycle, if your reporting date is in the middle of your billing cycle while you're charging it up, it may report 20%, 25%, or all 30% to the bureaus. That's utilization. Utilization is how much gets reported in the month. Our objective is to have a near zero utilization and a zero on the due date. And go to my boot camp if you need to figure this out for your particular situation. But I'm telling you right now, guys, you need to put traffic on every open credit card in your revolving accounts portfolio. But during the holidays, we have a tendency to charge more, right? We're trying to take care of our families. We're trying to take care of our loved ones. We're flying here or traveling there, right? Or we're going on special trips for the holidays. No harm, no foul. But if you're going to do it, you want to make sure that you do not put on your credit card to carry over. If you're going to take 2 or 3 months or more to pay these off, make sure on each credit card you do not charge more than 38%. 38% is somewhat the safety zone of what automatic underwriting systems look at before you go into the risk department. They're saying, we're willing to let you carry 38% if you're going to carry that balance over month after month and pay it down slowly. So that means you need to split your Christmas, your holiday, your Hanukkah and your Kwanzaa activities. You need to split those up between credit cards so that not even one of them exceeds 38% if you're going to carry those balances. If you're going to pay them off, make sure it's not more than 38% in traffic no more than 38%, and then make sure you pay it down to near zero before the reporting date. And then, of course, to zero and pay it off so you're not charged any interest. I know I'm talking tech, guys. Go back into our previous episodes. Look at the names of the episodes. We're talking about the revolving accounts and how to become fundable in the way you use your credit cards. All right. So that's number 3. Number 1, ruining your credit and saving 10% on your next purchase. Number 2 is raising limits past your available, too much available credit thresholds. And number 3 is running up balances and not spreading those balances, because we want to make sure your balances do not exceed, your traffic doesn't exceed. And if you're going to carry them, your balances do not exceed that 38%. Split them up. Now, some people say, well, is that average across my entire revolving account portfolio between all my credit cards? No, we don't want any single credit card to be more than 38%. Now, you can charge all of them up to 38%, but, and when I say you can, I'm saying if you have to, but do not exceed on any single credit card more than 38%. All right. So number four. Now, this is a big one, because in the holidays, many of the auto and truck manufacturers are on high alert. They're trying to get rid of the previous season. They're giving mad discounts on the late models and the new models. It's a great buying season for automobiles. Here's the problem. Many of you are going to be looking at okay, 0% interest, because we think that saving money on interest is our chief and number one concern, right? In my boot camp and in previous episodes, guys, we talk about how this is an illusion, right? It's a myth. But there is one thing we need to be aware of. If you're thinking, oh, I'm going to get this automobile and I have on approved credit and my credit's over 720, I want to qualify for the zero interest. Notice that the zero interest offers are always made by the finance arms of the manufacturer. Toyota Motor Credit. You buy a Toyota, you're going to get interest free from Toyota Motor Credit. Ford Motor Credit. GM, everybody is trying to not collect interest and thinking they're offering you what you think is a good deal. But what's happening is every one of those institutions are graded at a tier 4 finance company institution. So while you believe you are saving money on interest, you're on your credit profile, you're getting a finance company. Just like the consumer finance accounts on the revolving, this is an installment loan, auto loan finance company. Now, I do not believe in all my recollection, there has never been there's never been a 0% offer where they didn't also offer a rebate instead of the zero. So they give you a choice, right? Oh, give it $720 off the price, or 0% interest. You guys recognize that, right? It's one or the other. Interestingly enough, if you're at 720 and you qualify for the zero interest, that 720 is a paper. That's a paper for an auto loan. Well, that's what the interest costs would be in that rebate. It's just it's the same amount of money. One is being taken off the price of the car. The other is being taken off in interest. The beautiful thing is if you take the price off the car, you're saving money on the value of the car. But now you can go to your tier 1, tier 2, or tier 3 credit union and get financing there at a paper, because you wouldn't qualify for zero interest unless you had a paper. You can go get an a paper loan from your tier 1, tier, or tier 3 lender and save the same amount of money, because that interest charge you will make up in the savings you did on that automobile. It's just a shell game. To quote Scott Carson, it's just a shell game. you're going to pay the money one way or the other. The higher value of the car that you're buying, the higher price of the car that you're buying with zero interest, or a lower price because you're going to pay interest to a financial institution. It's going to cost you the same, whichever you do. The optimization model says, your fundability model that dictates that you save the money, go get a tier one lender, tier two, tier three, and finance your car there, pay the interest, and have a higher value instrument, an installment loan on your credit profile. So that's number 4. So let's recap. Number one is don't ask for the discounts by filling out an application. Just stop it. Don't do it, right? Unless you're spending $60,000 at Kohl's. Number 2, raising limits, especially multiple cards raising the limits all at once, triggers red flags. Number 3, raising balances past the 38%. Be careful of that. And number 4, thinking that zero interest is awesome and getting a tier 4 loan on your automobile instead of taking the reduced rebate price and then going and getting a tier 1 loan, a tier 1, tier 2, or even a tier 3. Even a credit union loan, guys, is better than that Ford Motor Finance or Toyota Finance. All right. The reason why they give zero interest is it's all the same company. They just want you to buy the car, and that's a sexy sell. Hey, no interest, because we're all sensitized to not paying interest is a cool thing, just like we're all sensitized that credit score is the thing that matters in our credit profile and our fundability. Neither one of those are true. All right. Then number five is that many of you, if you're going to go buy the car, and you may have seen this in previous episodes as well. If you haven't, welcome. I'm going to try and make it simple. If you're buying that car, then many of us are tempted to put money down on the car to lower the rate of interest, right? Totally get it. Totally understand. But that does not support your fundability in the long term. It doesn't send great messages to your current lender who carries that auto loan, much less future lenders who are looking at your profile for professional borrower status, right? Professional borrower capabilities. So what I teach my students, clients, and you today, what we want to do is we want to purchase the automobile. You can put something down if you wish, but save the money that you're putting down, go purchase the vehicle, finance the vehicle at 100%, and then take the down money and make it as your first payment. If you do that, you're going to end up at somewhere between 85 and 95% utilization on the first month of your loan. For loans, that's killer, right? There's a step down process. We call it the term rate. You're actually, every payment you make, you're stepping down the utilization equals the number of payments you've made, right? But what happens if you put more money as a payment ahead and you lower that utilization? That makes your lender just jump with joy. You're not spending any more money. There's no more money or less. And I know what you're going to say, but we'll cover that in a second. You're not spending more money one way or the other when we're done with this. But to make that first payment is use your down as the first payment is spectacular. Now, people ask me all the time, can I make it on the second or third payment? And I'm like, absolutely. As long as your payments are happening more, the balance is going down faster than the term, month by month by month, you're going to be ahead of the game. All right. So those are the key things. Now people say, well, hold it. If I instead of putting $5,000 down, if I save on a $20,000 car, my payment is lower by having a $15,000 purchase, right? Well, yes. So what you do is before you engage the lender, ask them if they reamortize loans. And what that means is that, let's say you put down, you buy it at $20,000, but then you make the first payment of $5,000. You're now at a threshold of $15,000. Your balance is $15,000. Many lenders will say, oh, since it's 15 grand, let's re-amortize the loan. Now, you don't want to go get a new loan because they'll close one out at month 2 or 3, and that doesn't help you. We want to keep our loans for 24 months, as you've learned in previous episodes. Bottom line is we want to re-amortize the loan by just making new longer payments at that new $15,000 amount. So those are the 5 ways that you can make choices that will hurt your fundability, guys. And they can happen, any of these can happen anytime during the year, but it is amazing to watch how many of my students and clients do these things in the holidays because we want to spoil our children, our siblings, our families. We want to take care of our boyfriend or girlfriend. We want to hook our spouses up. We use the holidays many times as an opportunity to show everybody how much we love them. Well, first thing I want to say is do that every year, every day, every year, all year long, guys. Show them that you love them all year long. But because we got this thing about the holidays, about ending the year with as much abundance as prosperity as we can, or looking like it, make sure that you take care, because December 26th, we're either going to have too high limits, we're going to have a new junk card on our profile, we're going to have too high of balances, we're going to have spent too much, we're going to have a new junk auto loan on our profile, or we're going to have we're not going to have optimized the way we bought our card. December 26th comes just like December 25th does, guys. And I want you guys starting the new year killing it, just killing it. I want you guys to have the best Christmas ever by following these tips. And then you start out the new year, no harm, no foul, and you guys are moving forward through the next year. You guys have an amazing holiday season. I hope that what I've shared with you can create both hope and an opportunity to make great decisions so that we don't have that post-holiday depression, financial depression. I hope you guys have a spectacular holiday season. Godspeed. God bless. We'll talk to you later. Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.